We have all seen the ads. They feature a trusted and well-known media personality. Buy gold! There's so many of them. Why is that? How did we get here? And what's in it for these media personalities? Gold is commonly traded and at very thin margins. Who's paying for all those TV and radio ads, and how do they afford that? How do they afford that on these thin margins, let alone paying for all these media personalities? Let's examine. It starts with a simple question. If gold is one of the most heavily traded commodities in the world, why do two people buying the exact same ounce sometimes pay wildly different prices? One investor might pay 3% over spot. Another investor might pay 40% or more over spot. Same metal, same weight, same periodic table element, same chemical compound, same global price, no matter how allegedly rigged. So where does the difference go? That difference funds an entire industry. And once you understand how it works, you also understand why many gold dealers do not want this conversation happening in public. And believe me, Crimex blushes at what these operators are pulling off legally and daily. The global gold price is extremely transparent. Gold is not some obscure asset. It trades continuously around the world. The benchmark price is established, no matter how dubiously, through major trading venues like the London Bullion Market Association, or LBMA, and futures markets operated by the CME Group in Chicago, and through the COMEX. Institutional trading happens primarily in 400-ounce London good delivery bars, and in that market, the spreads are tiny, often less than 1/10 of 1%. Banks trade gold with extreme efficiency, which means the wholesale price of gold is one of the most transparent prices in global finance. But that transparency disappears the moment gold enters the retail distribution system. Retail gold is a marketing business. Once gold leaves refiners and wholesalers, it enters a completely different ecosystem. The retail chain typically looks like this. First, the refiner, then the national wholesaler, regional distributor, retail dealer, marketing affiliate. Every layer adds cost, and in many cases, a very large cost. Standard bullion products, coins or bars intended purely for investment usually carry modest premiums. Examples include coins like the American Gold Eagle or St. Gaudens. Premiums, therefore, are often 3 to 8% above the metal value. That's normal. That's the traditional bullion market, and that is not where the largest profits are made. The real money is in semi-numismatic coins. I'll say that one more time. Semi-numismatic coins. The highest margins come from coins marketed as collectible or rare. They are not. These are often graded by really good companies like the Professional Coin Grading Services, or PCGS, or the Numismatic Guarantee Company, NGC. These are legitimate companies. They grade things like the St. Gaudens $20 gold coin that your grandfather might have given you, or maybe you got on your own. They may still contain 1 ounce of gold, the rounds, but instead of selling for a few percent above spot, the semi-numismatic coins sell for 20, 40, and in some cases, 80% above the gold value. Industry investigations and regulatory cases have documented examples of extremely high premiums in this category, semi-numismatic coins. And here's the key point. Those premiums are not primarily paying for the coin. They are paying for the sales and marketing system behind the coin. So let's follow the money. Retail gold companies spend enormous amounts on marketing. Common channels include talk radio, podcasts, cable news advertising, financial newsletters, and the like. Often, the structure works like an affiliate network. A media personality promotes a specific gold dealer. In exchange, the dealer pays for advertising or pays commissions tied to a completed sale. Former salespeople involved in regulatory cases have described commission structures between 5 and 15% of the transaction value. So let's put numbers to that. If somebody in retail rolls $100,000 from a retirement account into gold, the commission paid to the salesperson or affiliate could range from $5,000 to $15,000, and that money has to come from somewhere. And it comes from the markup embedded in the product. The gold IRA boom is the biggest growth driver in retail gold over the last decade. And that has been precious metals retirement accounts. These are the so-called gold IRAs. They operate under rules established by the Internal Revenue Service. The process looks like this. An investor rolls money from a 401k or traditional IRA into a self-directed IRA that allows physical metals. The metals are then stored with custodians in secure vaults. You don't have the physical in this case. Often facilities operated by the companies like the Delaware Depository. On the surface, the structure is legitimate, but the controversy arises in what metals are recommended. Many dealers steer customers towards high premium coins instead of low cost bullion. Why do they do this? Well, it's because the margins are the highest here. Why is this legal? Question of the day. People hear these numbers and immediately ask the obvious question. How is this allowed? The answer is that coins are legally classified as collectibles. That means they are not regulated like securities. If a broker sells shares of Apple, commissions must be disclosed and pricing rules apply. But collectibles markets work differently. Examples include art, rare wine, antiques, and, you guessed it, coins. A dealer can sell a collectible at any price the buyer agrees to pay. Price itself is not illegal. Only fraud is illegal. Regulatory authorities like the Federal Trade Commission generally intervene only when companies misrepresent rarity, guarantee profits, or make false claims about resale markets. Charging a very high premium alone is usually not a violation. So here's why investors don't notice. This is the subtle part. Most buyers track the price of gold, not the premiums they paid. If gold rises over time, they assume that their investment is working. But the starting point may already be deeply underwater. For example, if the gold price is, let's say, around $5,000 an ounce, and your semi-numismatic coin was sold to you at $7,000 for the same ounce, the gold would need to rise 40% just for this investor to break even. And when investors try to sell, dealers typically buy back based on melt value, not collectible value for a semi-numismatic coin, which means that premium disappears. This is the part the industry that many dealers worry about. The retail bullion business depends heavily on information asymmetry. That means they know more than you as the end buyer know. Most customers simply just don't know. The global gold price, typical bullion premiums, and resale market for the coins. Once investors understand those three things, the economics change dramatically. High premium products become much harder to sell. Why would you buy something that isn't worth what you paid? That's why transparency is the biggest threat to the model. Fortunately, Avoiding these problems is simple. 3 rules eliminate most of the risk. First, always check the spot price of gold. Sources like Kitco Metals publish real-time pricing. Second, understand normal premiums. For most investment bullion, premiums should generally be under 10%. Third, be skeptical of urgency. Phrases like limited mintage, special allocation, rare opportunity are often marketing language, not market reality. Gold itself is not the issue. Gold has been used as money and a store of value for thousands of years, and very successfully too. Central banks still hold enormous reserves, as they should, but the retail market surrounding gold can add layers of cost that investors rarely see, let alone understand. And those costs can turn a safe haven asset into a very expensive purchase, which is why the most important number in the gold market isn't just the price of gold. It is the spread between what the gold is worth and what you paid for it. To be clear, we are big fans of gold, as long as it is fairly priced gold. And if you were wondering where to buy it, Costco. They're not paying us, but in our personal experience, the most fairly priced gold, which you know is real, at the thinnest margin, is sold right there. Next time you may want to purchase some, we just may see you there when we are purchasing ours. Thank you for watching all the way to the end. As always, take care of yourselves and each other and build that stack!